Hello and welcome back, and in today's video we're going to talk about credit education. Guys, credit education is critical because my mentor told me a long time ago, and I hold on that today. Yes, cash is king, but credit is power. Cash is king, but credit is power if you know the strategies to how to use credit. So guys, wealthy people use other people's money. OPM, that's the system they use. They use the bank money, right? And so they don't use their own cash to put in deals. Why? Because they're able to leverage other people's money by their what? Credit, right? If you're gonna be utilizing hard money, they're gonna pull some type of credit. You don't need a 700 credit score like the bank. You can go down to 600, 620, but still, it's still based around your credit. Did you know, guys, that if you are filling out a job application to be employed by an employee, most of the time the employees today are pulling your credit to determine your character, right? If you're going to be a good employee. Yes, it's unfair, I get that, but that's the way it is. If you already have a job and you're looking to move up into a new position, most of the time they pull your credit before they hire you in that new position. Your car insurance, a lot of time is based on, the premium is based on your credit score. So your credit is very, very important, that you want to have the education behind it, how to raise up those credit scores and how to sustain those credit scores. For example, if you are living paycheck to paycheck and you have credit, then you can leverage your way out of that negative cash flow cycle. You can leverage your way out from living paycheck to paycheck. If you're in poverty, right, but you have a good credit score, you can leverage your way out of poverty. But what do you mean by that? Well, Randy, what do you mean, Randy? Well, what I mean by that is I have a partner of mine. He has a credit line from his business with over $500,000, a $500,000 line of credit. That credit only costs him, that credit line costs him between 3 to 5% interest, right? It's a revolving line of credit. Now, what he does is he invests in real estate as a private money investor or a hard money investor. So when he go and find a motivated investor like ourselves, we evaluate the deal property, the numbers make sense, he look at it, and he lend on that deal. He's only lending 60%, or the max is 70% of the after repair value that we talked about before. So he's protected because he have his money tied into a real estate deal. So he have a promissory note on the home, he have a mortgage recorded instrument, and it protected him because he have a tangible asset. And he's not funding 100% because you're gonna bring, or the investor gonna bring some money to the table. But keep in mind, he's charging 10, 12% interest, APR, sometimes it might be 15% interest. Plus he's charging 4 origination points or 4% of the loan amount up front, because the loans are only short-term loans. They're like 12-month loans, right? 12-month term loans. So after 12 months, that he gets his money back. But the idea is to give you enough time to be able to buy the property, rehab it, and resell that property. Then he gets his money back. But look at the profit spread that he's making. He have a $500,000 credit line that's revolving. He's only paying 3 to 5% interest to the bank because of his credit. Now he's lending that money out to the real estate industry, and he's making 10 to 15% interest plus 4 points. You see how you can leverage your way out of poverty, or leverage your way if you have credit, right? So credit allows you to borrow other people's money. So it's very, very important. So we have a team in place, guys, that helps you and the individual you know, the buyers that you're going to be putting into your pipeline, because that's the exit strategy that we teach. And as an investor, you have to know your exit strategy. If you're going to buy the property at a wholesale price, rehab it, and hold it for cash flow, then your exit strategy is to refinance the property and hold it for cash flow. If you're going to fix and flip the property and make that capital gain, that chunk of money, then your exit strategy is selling it to the end buyer that's qualified and credit worthy. So what we have a national company, a national team, no matter what city you're at in America, that we will take your potential buyers, you go out, you market for buyers, and you put them into our system, and we're going to assist them in talking to the credit bureau, sending letters to the credit bureau to remove negative items off their credit report. items that's erroneous, that's inaccurate, that's not verifiable, items like repossessions, foreclosure, bankruptcy, late payments, inquiries, collections, right? We take those negative items and we're able to dispute those and work with them to get them removed off the report. So let me give you an example of an unverifiable item. Well, 7 years is that magical number. If you have a negative item on your credit report for 7 years by law from the Federal Credit Act, that item has to be removed off the credit report after 7 years. But do the credit bureaus always do that? Of course not, right? They're busy, they're doing other stuff. But it's up to you to know that. It's called financial education. That's why we're teaching you these strategies. So if that item is 8 years old, 7.5 years old, 7 years and 2 months old, it has to come off by law, out of there, no questions asked. And other items that you may have that's on and is not 7 years old yet, but is unverified, meaning that the law states that if a company who actually puts you in a credit bureau for a late payment or collection, like repo, etc., that they have to verify their debt. So sometimes the business owners sell that debt to somebody else and they lose track of that record. They don't have the paperwork to verify that. Sometimes that business goes out of business, right? You know, it's a big chance that a new company will go out of business in the first 3 years. So let's say 2 years ago, the company went out of business. So when you dispute that item and say, hey, listen, credit bureaus, I want you to verify this debt, the credit bureau is going to call that company and say, hey, listen, I need you to verify this debt. But here's what the credit bureau is going to hear. Sorry, this number has been disconnected. Because they're out of business. If there's no business, there's no debt. They can't hold you accountable for a debt, a late payment collection, if they're not even in business anymore. The law protects you in that area. So by law, between 45 and 60 days, 30 to 45 days, that unverified item has to be removed off your credit report because the business is no longer in business anymore. They can't verify the debt. And I don't care if it's a bankruptcy, it's a foreclosure, it's a collection, it does not matter. It has to come off the report. So those are the things that our team does to be able to remove these negative items off the report. Then we have systems in place, we have the education tools in place to teach them how to maintain their high credit score and how to add on to their credit. And we also use a couple of strategies as a secure credit card that we have available to them that can help them to put the secure credit card on their account. Let's say they put in $500, right, on a secure credit card that we give them access to, and then they're gonna have access to a $500 credit line. The secret is to keep that credit line below 30% below of the high value. So if it's a $500 limit, then 30% of that you want to keep that below that, right? And so pay it on time every month, keep that 30% of the high value, and you can see that credit score go up. Also, we have a program in place that we can use rent payments. So if that person don't have any credit and we build in their credit, right? So we can actually add in the rent payment that they've been paying rent for all those years and use that as a positive trade line to help them with their credit. So guys, that's our team. Just like I said, it's a national team that we have. It's in tune with our vision, our social cause, Project 5000, to provide an affordable, attainable financial education and real estate education to 5,000 people across the country. That's going to allow 5,000 people to get the education and get in position to buy their first home and also start to invest in this. So we're building this large investment group. I hope you guys catch the vision. And having said that, you can make those referrals over to us, and it's a win for you because now we're filling up your pipeline of motivated buyers that soon will be qualified, credit-worthy buyers over the next 3 to 6 months, maybe a year, right? So we got this pipeline being filled up. So now when you buy those properties on the group that you're generating, the team that you created, as you all are flipping these properties, you got your end buyers in place ready to go. That is the secret, guys. It's not about getting into real estate. It's about getting out of real estate as fast as you can. So if you have a credit-worthy, qualified buyer ready to buy your property before you even finish the rehab, guess what? You won. You out of there. So now, even though that hard money lender charging you 12% interest, you only kept the property 2 months, 3 months. So it's APR interest. So it means whatever your loan amount is times 10%, right, that gives you your total amount. So if it's a $100,000 loan times 10%, that's $10,000 worth of interest that you're gonna pay to the hard money lender if you keep it for 12 months. Because you're gonna take that $10,000 divided by 12 months and that's gonna be your monthly payments. But if you get this thing sold in 2 months or 3 months, you won. You didn't pay that much interest. You saved on the interest. That makes sense? So if you also want to monetize, guys, your marketing campaigns, let's say you're marketing for motivated sellers, you're marketing for qualified buyers, and you spend $500, right? And nobody is qualified to buy a house from you, right? So now what you can do is monetize our credit restoration company, where you refer them to us. They'll go into your pipeline, but you'll make $100 of every customer that you refer that actually signs up in the program. So they'll go into your pipeline for future business, for future homeowners, but you'll make $100 off. So your marketing campaign, you spent $500, you spoke to 30 people, none of them are ready to go, none of them qualify, and 5 of them decide to get started to building their credit. You just made $500. The same $500 you spent. So now you can take that $500, put it back into your marketing campaign and continue to market. But what if more people decide to sign up of the 5? So you talk to 30, maybe 10 people sign up. Now you got you made $1,000, right? You get my point. So there's 2 ways. You can just refer your clients over to us. We'll take care of it for you on our behalf, and we'll simply get them in your pipeline. But if you want to make the referral fee, then you become an agent of ours, a partner of ours, a broker of ours, if you will, and then you make the $100. You're still not doing the work. We have a team of credit attorneys that's talking to the credit bureau and assisting them on on your behalf. So you're not gonna do all that work. You just gotta make the choice. Excuse me, if you're gonna make the $100 for the referral, or you just simply wanna, just make the referral over and we'll take care of that for you. So having said that, guys, I hope that information been helpful to you. That's our credit education piece, and I'll see you guys in the next video. Hope that helped.